recording and slides will be made available after the webinar. There will be Q&A at the end of the presentation too, so please just add your questions into the Q&A box as they arise. Joining me today, Alex Hillman, doesn't really require any introduction, but for those that don't know Alex, he's ACCR's lead energy analyst. And we will be taking you through the members' statement that ACCR, along with 100 of our supporting investors, has filed against the re-election of Anne Pickard, Ben Wyatt and Anthony O'Neill. So I will hand over to you, Alex, to get us going.
Thank you very much, Gemma. So what we're covering off today is a member statement, which, as Gemma said, is voicing our views and reasons for not voting for the re-election of Anne Pickard and Ben Wyatt or the election of Anthony O'Neill. There's two broad themes that we think are key to this. One is a failure to respond by the company to significant and chronic financial underperformance, and a failure to materially respond to escalating investor feedback on management of climate risk. So the three directors up for election or re-election are Anne Pickard, Ben Wyatt and Anthony O'Neill. We think that the performance of Woodside on the board merits, is a shared responsibility of the board. These three are up for election or re-election though, and we think it's justified to vote against all of them. Anne has been the chair of the Sustainability Committee since 2017 and oversaw both climate plans that received world record-breaking votes against. Ben Wyatt was on the Sustainability Committee for a period of time and is now the current chair of the Audit and Risk Committee. So the Audit and Risk Committee explicitly states, or Woodside explicitly states, that it has assessed climate change as a risk. Tony O'Neill is the newest member of the board. He is on the Sustainability Committee, and he has been involved in the response, or the inevitable discussions that would have happened after last year's vote, as well as the recent acquisitions of Beaumont Ammonia and Louisiana LNG. So we think a vote against all three of these directors is warranted. We also think that it's consistent with best practice corporate governance. So when you have a look at voting policies of mainstream proxy advisors and other governance expert institutions, it's pretty consistent that voting against directors when boards fail to live up to expectations is a reasonable thing to do. So this quote here from the ASX Corporate Governance Council is that it's a fundamental underpinning of the corporate governance framework for listed entities is that security holders should be able to hold the board and through the board management to account for the entity's performance. So we'll dig a bit deeper into the entity's performance, which I don't think many people would say would count as successful. ACCI has also got similar advice out, and the major proxy advisors as well. One of the proxy advisors specifically mentions that voting against the chair of relevant committees is an appropriate step as well. In previous years, it's not just a 2025 issue. In previous years, we've seen asset owners and asset managers with trillions of dollars under management who voted against Woodside directors. The reasons, in our view, the reasons for those votes against directors previously remain. And in fact, when one of the key problems is a lack of responsiveness, the fact that there hasn't been a material shift, in our view, exacerbates and increases the justification for voting against these directors. So starting with financial performance, Woodside has persistently and chronically underperformed both the Australian and global share markets, as well as the oil and gas sector, or the MSCI World Energy Index. So over 15 years, it's generated just 0.7% total shareholder return. And over 1, 5, 10, and 15 years, it has underperformed both the ASX 100 and the MSCI World Index. The only time it's outperformed these broader equities indices is over a 3-year period. And that coincided with the Ukraine war, which obviously triggered massive disruptions to the energy markets, huge prices and outsized returns. Even during that period, though, where the whole sector generated substantial returns, Woodside underperformed the sector. When we look at a key element of Woodside's investment framework, its assumptions around oil price are misaligned with the super majors. So at the start of the year, Woodside was one of the higher had one of the higher assumptions. Since then, some of the super majors have reduced their oil price assumptions, and Woodside increased its assumption. So it went from, pardon me, having the before the 2024 annual report was released, its latest disclosure had it as the highest, had its oil price assumption as higher than any of these peers listed in this group. And then it announced or included in its assumptions on that in the annual report a 7% increase. So it isn't just misaligned with peers, however, or the super majors, it's also significantly above the market. So this graph here shows the implied nominal Brent price for these companies and also the forward price. So at the moment, the forward price for 2030 for Brent is under 70. And when you calculate what Woodside's assumptions are, it's close to 90. So it's 30 or 29% higher above market. Obviously, when you assume a higher oil price, you're assuming greater revenue for your projects, which makes it more likely you're going to sanction projects which other organisations would not. If Woodside was performing better than peers and it had outlier assumptions, you could see that may be justified. When they're performing worse than peers and have misaligned assumptions, we think that raises serious questions about how they're assessing their capital allocation framework. Turning to Woodside's previous projects, we'll start with a couple of examples of projects that Woodside's started or is currently operating. So Woodside in Q1 this year put out a statement updating Sangomar, providing an update on Sangomar. It said it was outstanding. But when we have a look at the fundamentals of Sangomar, we don't see it as creating shareholder value. We estimate completely the opposite, that it's actually eroded $835 million of shareholder value. So, Woodside said it started up reliably and then it generated significant cash flow. But what they didn't say in that Sangomar update is that in previous ASX disclosures, they've acknowledged in multiple rounds of updates that the project was late and over budget, so 18% over budget and 12 months late. Woodside also spent over $1 billion acquiring its stake. So originally it bought a 35% stake off Conoco, and it was talking about trying to sell down the project at that point or shortly after that point. Rather than being able to sell down the project, two other partners pulled out for various reasons and it had to increase its stake. So, counter to what it seemed to be its strategy, it's had to increasing exposure and put $1 billion of nominal capex into the acquisition. And we've rolled that into our calculation of the 835 eroded NPV. Even if we take at face value that the project started up reliably, it did start up with a huge quantity of emissions. So Woodside hasn't specifically spoken about or disclosed the emissions from the project, but it is the only project that has in Senegal, and it did disclose that. So it started up in June, and when you gross up the emissions to 100% share, the project in 7 months emitted 1.1 million tonnes of CO2 equivalents. When you compare that, to give a sense of scale, Australia has 3 operating oil FPSOs. That's about 18 months worth of their emissions. So, in 1 year of operation, Sangomar has emitted about 18 months worth of 3 other oil FPSOs emissions. So we think the way Woodside's presenting Sangomar as an outstanding project glosses over or obfuscates the challenges it had and the fact that it's just actually eroded shareholder value. This isn't the only time Woodside's done that. It's for a long time spoken about how Pluto's a pillar of its business, but Pluto is 70% over budget according to Rystad data, and 2 years late according to Woodside's ASX announcements. When we have a look back at Pluto's life cycle value impact, we conclude that it eroded $2.7 billion of NPV. So I think Woodside is demonstrating a tendency to talk about significant cash generation and cash flow, and not talking about what we think is more important about value creation. Obviously, you can have lots of cash flow and still erode value. We think it'd be more transparent for Woodside to be talking about life cycle value rather than just cash flow. So that's looking back at some of Woodside's completed projects. When we look forward to its growth portfolio, There's three major upstream gas projects which it's progressing. The largest of those and the most prominent of those in Woodside's disclosures is Browse. When we've had a look at how Browse compares to pre-FID gas projects around the world, we find that it's more expensive than 70% of its peers or its competitors. And when you compare it to specific projects, or specific opportunities, which are extremely large, they're much, much cheaper. So the Permian Basin, for example, is a break-even gas price of under $2. And Qatar LNG is about $2 as well. So, significantly cheaper than Browse. Woodside's been progressing Browse for literally 50 years. It's had multiple FEED studies completed. It's had a negative FID. Just on the disclosures that we could trace down, which cover about a 6-year window, it's had $800 million of development costs sunk into this project. To put that $800 million into perspective, BHP's the independent expert report into the merger with BHP Petroleum valued this asset at $398 million. So even before you account for the time for any return on capital, Woodside spent at least twice as much developing this project as it's currently worth. And it may not surprise you that our view is that Browse is not Paris aligned. So that's their biggest upstream gas opportunity. But they're also continue to progress Sunrise and Calypso. These are even more expensive than Browse. And in fact, when we built this graph out of Rystad data, Sunrise was actually not in the data set because Rystad doesn't deem it to be commercial. So we had to manually add that when we were comparing it to upstream opportunities that Rystad deems to be viable. What gets a lot more attention now than Browse is Louisiana. So this isn't an upstream position, so slightly different type of opportunity, but it's still a very large LNG project. So it recently bought Louisiana, or it was Driftwood at the time. So Woodside bought Driftwood from a company called Tellurian and relabeled it, or renamed it to Louisiana LNG. So similar-ish to Browse, when you compare Louisiana to its competitors of other US LNG trains, it's more expensive than 70% of those. Woodside's targeting FID, or was targeting FID for Q1 2025. That's obviously slipped. Yeah, and if it does make FID on that project, or the foundation project, it's going to see Woodside's Scope 3 emissions increase significantly by up to 27%. In the last couple of days, I think two days ago, Woodside announced a sell down of part of the infrastructure, so not the whole project, but the infrastructure associated with Louisiana LNG to a private equity firm called Stonepeak. We don't see this as a vote of confidence in the project for a couple of reasons. Firstly, Woodside purchased Louisiana LNG or Driftwood for about $1 billion. It subsequently spent $200 million in Q4 2024. So there's $1.2 billion, or a bit over $1.2 billion that Woodside spent on this project. Stonepeak isn't providing any value, it isn't providing any cash as part of this deal. All Stonepeak is committed to doing is contributing their share of future capex. So Woodside has effectively gifted that the 40% share of that $1.2 billion to Stonepeak. When you look at the risk reward built into the deal, Woodside retains 100% of the capex risk. So if it does go over budget at all, then Woodside wears all of that. And Woodside also retains all of the market exposure. So the upstream gas price and the downstream LNG price. Stonepeak is insulated from that with a tolling agreement. Woodside, I suspect, would point this out as a positive for the deal. But what we've always said is that it's the typical way that you would get exposure to US LNG is just with an offtake contract. And it seems a remarkably capex heavy strategy to build an LNG facility if Woodside sees the value in just the offtake. From a project management perspective, one thing we're a bit surprised doesn't get more attention is that this project hasn't reached FID, but it's significantly progressed construction. So obviously, when you build a multi-billion-dollar project, you want to make sure that the plan is robust and signed off before you get started. Otherwise, that increases the chances of things going over budget or coming in late. So we've seen with Sangomar and Pluto that Woodside does have a history and a track record of delivering projects late and over budget. So we think not following standard project management practices raise a couple of questions. The disclosure or the announcement of the Stonepeak deal talks about about $2.6 billion worth of expected spend in first half of 2025. Yeah, it's about 3 times as fast as the burn rate of what Rystad has assumed. So yeah, it's not just progressing a project pre-FID, it's progressing a project multiple times faster than industry analysts, including Rystad, think is typical. We also don't see any evidence that Stonepeak has any significant LNG experience to bring to the deal. So we had a look at Woodside's returns are poor, their assumptions are aggressive, their previous project track record is checkered, let's say. Its growth options appear to be weak and non-competitive. But even if it did have a competitive portfolio, when you have a look from a carbon climate perspective, there's no room in a Paris-aligned carbon budget for any new oil and gas developments. So what we've got on this graph is the remaining carbon budgets from the start of 2025. So they'll be incrementally smaller than this now, for 1.5 degrees in the blue and well below 2 in the green. So well below 2 is taken as a 90% chance. In accordance with academic literature, we've used a 90% chance of staying below 2 degrees. So the well below 2 degree budget is 430 gigatons of CO2. Just sanctioned oil and gas projects, so those that are operating now or are under construction, are forecast to emit 460 gigatons of CO2. So even with no new sanctions of oil and gas projects, the oil and gas sector alone consumes all of the Paris-aligned remaining carbon budget. Obviously, if you allow for some emissions or some of that carbon budget to be used by coal, cement, or the land sector, there's a smaller share left for oil and gas. So yeah, poor project execution record, poor growth portfolio, and no remaining carbon budget. When we turn to climate governance, we see that Woodside has been remarkably persistent in not addressing investor concerns. We've seen really clear patterns of escalation by investors against the climate plan. And what we've seen Woodside do is basically restate its climate plan and meet more and more with investors. So we don't see this as a substantive response. And in fact, we've seen a trend of Woodside to dismiss the significance of these concerns over time. When we look at the climate plan, so Woodside put out a climate report in 2021. This received, at the time, the world's worst vote, with a 49% vote against by Woodside's investors. When we had a look at the voting rationale for this, there's a couple of things that stood out. One of them was a lack of say on climate, or no commitment to future say on climate votes. There was a say on climate vote last year, so that was a compromise made by Woodside. But what we've seen, as we'll go into a bit more detail, is that even though the vote got even worse on that follow-up 2024 say on climate vote, we haven't seen a material response to any of those concerns. Another concern was that the emission reduction targets aren't science-based. So Woodside had a 15% net equity emission reduction target by 2025 and 30% by 2030. This hasn't changed. So in the 4 years since then, Woodside still has the same scope 1 and 2 targets. In terms of scope 3, so Woodside talks about having scope 3 abatement targets, but these actually do not touch Woodside's scope 3 emissions. So that sentence sounds a bit counterintuitive, but it is true. Woodside has a target to spend money on things which may reduce other people's emissions, but don't actually reduce Woodside's emissions. In 2023, in the 2023 CTAP, which received the world's worst say on climate vote, what it did introduce was a new way to measure those activities. So as well as a $5 billion CapEx target, it introduced what they called a emissions abatement target, which is an estimate, Woodside's estimate of what its new energy projects and products would reduce in other people's value chain. So Woodside still has no target to reduce scope 3 emissions after all of that. And we saw an over-reliance on offsets was another investor concern. So in 2021, base business for Woodside would see Scope 1 and 2 emissions increase, requiring net scope, the difference between absolute emissions and the target, to be met with more than 100% offsets. So offsets to get back to the baseline, and then offsets to get to the target. We haven't seen any change to this. There's a bit more detail that has come out in terms of granularity of disclosures. The main source of emissions reduction that Woodside's looking at is still either abatement, which it says is currently too expensive, so $200 to $500 per tonne, and offsets. And in fact, in 2024, we saw the use of offsets double. So that's the climate plan and how it has, let's say, not evolved in the last 4 years. When we have a look at just 2024 climate performance and where the company's going, we can see that Scope 3 emissions increased by about 2 million tonnes of emissions. Scope 1 and 2 emissions increased due to in part, the startup of Sangomar, which, as I said, had remarkably high emissions for an oil FPSO, and emissions intensity also increased. So most of the reductions, as I mentioned, most of the reductions in Scope 1 and 2 emissions that Woodside is looking at, it says are not cost effective at the moment. Things like CCS and electrification. Its new energy space, it acquired Beaumont Ammonia. So this is an ammonia project in Louisiana, which has a contract to purchase hydrogen. And then the supplier of the hydrogen has a contract for the CO2 to be sequestered. So there's a contractual chain where this ammonia produced at the facility could be blue, but it's looking to start up as a grey ammonia project this year, with a target to shift to blue ammonia next year. So if that contractual chain delivers, and it is blue ammonia, this project will meet 50% of Woodside's $5 billion capex target and about a third of its 5 million tonne per annum abatement target. When we look forward, I think the key issue, more than 90% of Woodside's emissions are Scope 3 emissions. So it's hard to think of a climate strategy being credible when it doesn't reduce those 90% of emissions. If Woodside makes FID on Louisiana, then its Scope 3 emissions will increase by at least 27% for just the foundation project, and up to 91%. So if Woodside doesn't manage to sell down the trading part of that project, and it does make FID on all future trains as well, then the emissions from just that project would be 91% of Woodside's 2024 Scope 3 emissions. When we look to investor feedback, we've had pretty consistent escalation from investors. So the last couple of years, we've had, actually, I'll skip through to this one. So in 2020, we had 50% of investors support an ACCR resolution calling for the company to set Paris line targets. This is the first time an ASX company had a 50% vote on a climate resolution. The Woodside's response was that LNG, basically that LNG helps reduce emissions by displacing higher emissions fuels. So, we'd obviously contest that, but, the thing that comes out of that, in our view, is like this lack of kind of the company taking that seriously, and just kind of downplaying the significance of that vote. The 2021 climate report was voted on in the 2022 AGM, received the world's worst vote against a climate plan. The response from the company was that there was strong support for directors and strong support for the BHP measure, and therefore there was no genuine criticism from investors of the company strategy. We saw the 2022 climate report at the next AGM. There was no sound climate vote there, so there was no opportunity for investors to voice concerns directly on climate change, on a climate-related vote. But we saw record-breaking votes against directors. So Mr. McFarlane had 35% vote against, at more than 3 times worse than any other Woodside director on record. And then Woodside's response, again, downplayed the vote with a joke that as a former politician, he got more than 50% of the vote. So he was going to be happy with that. Last year, we saw the CTAP. Yes, it was, to be fair, a very detailed disclosure. And what we saw, though, was that there was no substantive change, and we saw a lot of pre-declarations. So investors pre-declaring against the CTAP and also pre-declaring against the chair's re-election. In response to those, when challenged about or asked about those pre-declarations, the response was a lot of those investors were pre-declared with very, very small shareholders. And Woodside said they would engage with serious shareholders in Woodside on where to go. So again, you see this downplaying of very sophisticated multi-trillion-dollar investors, and Woodside not taking their feedback seriously. Earlier this year, a couple of months ago, they published a climate-related investor engagement. So this is it's the first time they've published it that we're aware of. It seemed to be, presenting Woodside as actively listening. It didn't say that it was going to do anything different in any material sense. And the general pitch from what we took away from it was basically that investors ask for different things, and therefore it's quite hard to know what to do. The first, significant or, substantive graphic in this document was this graph here. So, as I've said, Woodside's 2024 AGM saw a 58% vote against the climate plan, the world's worst vote against the climate plan. 58% doesn't appear on this graph, because what Woodside has done is they've included issued shares that didn't vote. So the biggest wedge on here is that middle blue on the right-hand side, 41% of shares weren't voted. And that means that yellow wedge, which is voting against the climate plan, it's only 33%. It's clearly not how votes are counted. If you did count votes on that basis, then Goyder would have had Richard Goyder, the chair, would have received 49% support last year. So, they actually tried to present this as increased transparency, but it's obviously been applied selectively. And we think it's just the latest example of Woodside not taking significant feedback seriously. So that's the end of the slides. So over to questions, Gemma.
Thanks, Alex. Okay, so if anyone has any questions, just please pop them into the chat. I guess we have obviously been chatting to investors for the last couple of months now, and presented on the ACCI and IGCC webinar the other day as well. I mean, I think one of the key questions we do keep getting from investors is about the fact that, voting against 3 directors appears to be destabilising. I guess, we have answered that. I mean, obviously, we filed a member statement in 2023 against the 3 standing directors then. And, we don't see that, much has changed over the last few years. And for all the reasons stated in the presentation today, we think, or we do believe, the whole board deserves to bear responsibility for the current governance failings. I guess, Alex, do you have any sort of views on that point about 3 directors being voted off the board being destabilising?
Yeah, exactly as you said, we think it's proportionate. Woodside's demonstrated time and time again after multiple years of escalation that it's not going to take this seriously, and we think voting against 3 directors would be proportionate. We also understand not every investor is going to be in that space. And so if investors are going to be kind of, let's say, high grading, then we'd suggest that Anne Pickard is the most senior director and the chair of the Sustainability Committee. So she would be the, let's say, first choice for an investor is willing to vote against 1 director. And then Ben Wyatt, as the chair of the Audit and Risk Committee, would be the second choice. But yeah, we think it's proportionate and consistent with good governance to vote against all 3.
I don't think we have any more questions in the chat. I can just maybe throw a couple more at you that we've had along the way, just so we've covered off, I think, on all areas of concern. Doesn't the Louisiana sell down give some comfort about the financial impacts of the strategy? Do you want to just comment on that, or is there anything more to add on that?
It's really stark that Woodside's receiving 0 value for something it spent $1.2 billion on. And the fact that it's trading position, like if it sees value in trading around this asset, like we actually think you can get exposure to US LNG trading without spending multiple billions of dollars worth of capex. So yeah, we got questions about the strategy. We got questions about the cross subsidy of the project with trading revenues. Yeah, and we don't think that this the Stonepeak deal assuages any of those concerns that we have.
We have it, but of the broker notes, I guess it would sort of come across over the last couple of days. I think sort of generally the market agrees. And do you just want to add something on LNG, Alex? Obviously, we do get this a lot. The world needs more LNG. I do want to point out that we've published an excellent report on Shell's LNG outlook, which really sort of goes into the detail of our views on this. It has just been published on our website. I think we sent it to investors last night, so it should be in your inbox. But if you don't have that, then please reach out. But with relation to Woodside, Alex, do you have anything to add?
So yeah, Woodside's strategy is clearly built around a really bullish view of LNG. We think that's misaligned with independent analyst views. So we see the IEA talking about a glut in the second half of this century. Bloomberg, a bit more specifically, is talking about a glut, and that's the word those agencies both use. It's not just an ACCR term, so they're talking about a glut. Bloomberg from 2027. So LNG is a very useful commodity. It can do lots of things, but it's also a very expensive commodity and obviously a fossil fuel. So while there's going to be a role and a sustained role for some LNG, we think you don't want to overstate how strong demand is going to be, and we think there's significant risk associated with making investments that rely on a really strong LNG market. From an energy security perspective, lots of people talk about the massively increasing energy demands of the developing world. We completely agree with that. So the developing world is obviously developing at pace. Its energy needs are developing very quickly. And it's also very price sensitive. So if you need lots of energy and you're price sensitive, then you're going to be going for the cheaper sources of energy, which are clearly renewables. So solar alone has been growing at twice the pace in the electricity sector, has been growing at twice the pace of gas over the last 4 years. Obviously, renewables increase that further. So we don't see LNG or gas, let alone LNG, as the way to solve energy security. And then from a climate perspective as well, I think it's contested whether or not LNG has lower emissions than coal. But even if you take that at face value, there was a US Department of Energy study that was recently published, and they built 5 scenarios, and they looked at increasing US LNG exports. In every one of those scenarios, more LNG resulted in more global emissions. And that's because LNG, most of what LNG or incremental LNG does in the market is increase energy consumption and displace renewables. So, the net impact of more LNG is more emissions, which just kind of makes sense at face value because it's obviously a fossil fuel that creates greenhouse gases when you burn it.
I think we can probably wrap up there. If you do have any follow-up questions, please just reach out. You can get Alex or I. I'm sure you have our emails, but otherwise stewardship@accr.org.au will reach us. So yes, please, any questions, shoot them through, and yeah, hopefully good luck with the voting season, and hopefully we'll be speaking again soon.